Hey everyone, in this video I'm going to be talking about what I did with my stock portfolio over the last week in the markets. I made some new stock buys, which is really exciting, adding to both existing positions, but also adding some new stocks and ETFs to my account. So stay tuned, I'll talk about those a bit more throughout. I'll also talk about my overall performance as of late in my portfolio. It's been a bit tougher over the last couple months, so we'll talk about why I'm still holding some of the stocks that have started to go down and what I plan to do from here. So if you like this kind of content, be sure to give this video a big thumbs up. It really does help with the YouTube algorithm. And if you haven't yet, consider subscribing to the channel for more videos like this or just independent stock videos as well that I have on my channel. Okay, so we're going to just jump right into it here. We'll start on the Canadian side. So you can see off the bat here, my portfolio is down over $5,000 in the last month alone. As I go to the last 3 months, also down a similar $5,000. In this week specifically, it was about flat. So not the bounce back I was hoping for, but it could have been worse. In terms of why my portfolio has been down so much, it's a couple drivers of that, and I'll kind of go through and talk why. It's really three big areas of my portfolio that have been underperforming. The first one is real estate. So I do have a lot of REITs in this account. Here's one as an example. And over the last month, these REITs have gotten clobbered. So Allied there down 7%. I also have a couple other REITs like RioCan, First Capital REIT. I have Realty Income on the US side of my portfolio. All of these REITs have gone down 6, 7, 10% in the last month as the narrative of higher interest rates and higher for longer really take hold. Also as some REITs that are in spaces like Allied, that has some office exposure, the fear of not being able to re-up mortgages and lines of credit and stuff like that, because some banks don't want this type of exposure, is really taking a bit of a toll on the valuations. But I honestly think this is probably the cheapest funds from operation multiples that I've seen in the market since those first couple months after COVID. And I think that these are some of the largest, best real estate companies in North America, and they'll find a way to get out of this bind, and eventually interest rates will probably somewhat correct. Funds from operation growth will continue to accelerate, and I think the valuations and the multiples will go up from here. Here's another one, CAPREIT, Canadian Apartment Properties, largest residential REIT in Canada, down 9% in the last month. The second thing really has been energy. So you see Fortis here, decent sized position for me, almost $9,000. When I go over the last month, Fortis is down about 7% here. Another one is Canadian Utilities. Canadian Utilities over the last month is down 6%. So that's been an area of weakness. And then last but not least has been banking. With interest rates, some earnings reports coming out, I think banking is really well valued right now. Bank of Nova Scotia here down 5.5% on the month, despite already being down huge on the year, now down 18% on the year. But Bank of Nova Scotia is trading at a trailing PE at 9 times, a forward PE of closer to 8.5 times. Their dividend yield's getting close to 7% starting yield. And this is for a company that's increased their dividend 40-something times in the last 50 years. So odds are, as long as nothing catastrophic happens, that 7% is just a starting point, and you're going to get raises on raises on raises for decades to come. And I'm looking to buy more of Bank of Nova Scotia next month and continue to get in on that 7% starting dividend yield, because I think it'll be over 10% by the end of the 2020s. So that's a great yield on cost opportunity for a really state-of-the-art company that's a couple hundred years old. Another one here that I actually recently added, and I'll talk about that in a minute, but is actually TD Bank. I added some more shares to TD Bank this month in this account, so you can see there at the bottom. But TD Bank's had a bit of a tough month, down here about 6.5%. They had an earnings report a couple days ago, and they actually announced they're going to be buying back about 5% of the company over the next year. So getting 5% of the shares bought out. In addition to that, this company pays a 4.7% dividend yield, really strong exposure in Canada and the US, specifically the north and the east side of the US. So probably my favorite bank stock is TD Bank here. So those are really the three areas of weakness that I've seen on the Canadian side. It's my REITs, it's my utilities, and it's my banks. And that, unfortunately, since I'm primarily a dividend investor, holds a good chunk of my overall portfolio here. So in terms of what new stocks that I bought in my Canadian portfolio, there was a couple that I've been adding to. The first one, Jameson Wellness, I added back into the portfolio. I just have gotten up to 30 shares. Most of this was this week. I'm about flat on this one as I've averaged down. But my thesis on Jameson is they just have a lot of growth opportunities. You see here down 12% in the last month. They're going to make about $1.60 earnings per share this year, so trading about 17 times. But this company has a lot of growth opportunity in the US. They just acquired a US-based company for the first time, so they can expand distribution there, or at least attempt to, and build out their presence there. They also have some synergies on production plants and manufacturing and shipping and stuff like that. They just bought out their wholesaler in China as well, so that's another growth area that they'll see come online next year. And they just have a lot of other opportunities to expand into new markets still. So I think for a company that's had growth CAGRs of double digits, 10, 11, 12% over 5-year, 10-year periods, getting it at a 17 times multiple when lots of stocks in the market that are in this realm of consumer packaged goods are trading 25, 26 times, you're getting like a 30% discount on multiple off the bat before accounting for the fact that Jameson's actually in a faster growing space, which is wellness, vitamins, minerals, than lots of these other companies. Think Coca-Cola, which I also own, trading 26 times, and lots of their business are in sodas and products like that, while more global probably doesn't have the same kind of secular tailwinds that Jameson Wellness is facing. So this is one that I'm continuing to nibble on every week as long as it stays at a reasonable valuation. And it may turn into a big position if it keeps going down or some earnings reports comes out and I like what they are. But this is one that I've been nibbling on over the last week for sure. The other one that I briefly mentioned was TD. So TD, I built my position up to 100 shares here. Now it's a pretty notable position in this portfolio, $8,000. The company pays a 4.5% dividend. So on that, I'm getting about $100 a quarter in this account from my dividend payments on TD. They're expected to do about $8.50 in EPS, so trading at under 10 times earnings for a bank that operates in very developed, very strong economical markets here in Canada as well as the US, and is one of the leading commercial banks in Canada and the US, which tends to be a bit of a less volatile profit center in times of hardship for the bank. So I like that element of their business as well. Going through one of the other stocks that I just slightly added to was Keg Royalty. Got up to 90 shares from like 50 or 60. They reported their earnings this week. They actually disappointed a bit. Earnings were down about 2% versus a year ago, but they still made more than enough royalty income to cover their 7.8% dividend yield. So I'm in this one for the cash flow. Love getting that monthly royalty check from the Keg Royalty to fund other initiatives across my portfolio. It's not a big position in this account, just about 1%, but I did add to it on the weakness since they're down 4 or 5% since reporting earnings a week or so ago. In terms of new stocks that I bought in my Canadian account here, the biggest one or the most notable one that I added was an ETF. It is the TSX Cap Composite Index ETF. The reason I added this ETF, which essentially just mimics the TSX's performance, is just because I was at a point where lots of the times I was trying to invest more money into my Canadian portfolio, but it wasn't anything specifically that was calling my name. This ETF has about a 0.05% management fee, so essentially costs nothing to use and to get the diversification, and they own the entire TSX. So I thought it was a great place to park money, build a position that really just takes away some of the risk in my portfolio, being really geared towards those dividend-paying stocks. But the other thing with it is I'm still getting those dividends. So since the banks, the energy companies, stuff like that are such a big part of the Canadian economy, still getting about a 3.2% yield on this one paid out quarterly, which I like as well. Looking at this stock over the last 20 odd years, if I go to Max, it was launched in 2001. It's performed really well over time. It's not overly volatile, jumping up and down 20, 30%. So I like the stability. And this is just as my portfolio gets bigger, me de-risking it a bit, maybe minimizing the opportunity to get outsized returns, but I don't really need that. I'm just looking for consistent dividend income, building my dividend snowball over time, and that's where I think XIC plays a nice role in complementing that within my portfolio. So still a pretty small position overall, just 15 shares I currently have in it, but looking forward to building this one up to 100 plus shares in the relatively near term. Okay, so that's my Canadian portfolio here. Overall, it's dipped a lot. So overall, I think I'm up about, only a couple percent here. I used to be up 10, 11%. So that's a bit disheartening. But once again, I'm mostly a dividend investor. I'm just investing for the cash flow. I obviously like when the stock prices go up. It's a good sign that the business is shooting on all cylinders, performing really well. I'm in the position to increase their dividends, which is important to me. So I still do care about the stock price, but for the most part, looking for that cash flow and sustainable and growing cash flow over time as I look across my portfolio. So not too fussed with short-term volatility in the absolute value. Going over to my US portfolio, this one's performed a bit better, up 16% all time here. In terms of more recent periods, as I go past 1 month, a bit of weakness, but nothing like the Canadian side. On the US side, it's really been in realty income. So realty income here over the last month has gotten hit down 12%, one of my worst performing REITs, or probably my worst performing REIT over the last month. And that's really the entire driver of the loss there, or else I'd probably be in the green. We have stocks like Google that have performed really well. Coca-Cola has been extremely stable, not really going up or down, especially over the last year here, going between $57, $62, currently right in the middle around $60. This has been a pretty big position, almost 10,000 US dollars in it. And I get a dividend of about 3%, so about 300 US dollars a year coming from Coca-Cola in this account currently. Got some big tech companies, so up over 30% on Microsoft, over 170% on Meta. McDonald's is one that I'm up on. Just really expensive company, trading at like 26, 27 times earnings, so haven't really been adding there. Realty income, haven't added too much to as well recently, even though I probably should add a few shares. I think I added 5 shares end of last week, early this week, I forget where, to go 150 to 155. But these would be fresh lows for me. I'm actually down about $750 on the stock now with this down drip that we've been seeing. And Visa, AT&T, Visa's actually performed really well for me in the last month, up 2.5% despite some weakness in the market. So overall, not as broad issues on the downside for my US portfolio. A couple stocks that I did add to this portfolio for the first time. The first one is an ETF. It was the Vanguard Total International Stock ETF. So this is a company that owns a collection of ETFs and stocks across pretty much every country in the world. So you're getting total market exposure with the exception of the US market. So this does own, I think, about 7% the Canadian market, 7% the Chinese market, 10% the United Kingdom. It owns Australia, France, Italy, Netherlands, etc. So you're getting exposure all over the map. They also have a management fee that's a bit higher than XIC because of all the workings of putting that portfolio together. I think I pay 0.45% on this ETF a year, which is probably the high side I'd want for a non-covered call ETF. But I'm really getting super rich global and international exposure, which is hard to get. So willing to pay it for now. Looking at this one, up about 3% in the last year. In the last 5 years, it's about flat. Lots of international markets weighing down on that. They've had a lot of currency risk with the US dollar going up behind interest rates going up, and a lot of other things as well throughout COVID. So a bit understandable. I think it's a good opportunity for me to start getting in. I must admit my starting position is extremely small. So I only have 3 shares in this right now, but similar to XIC, this is going to be a priority over the short to medium term to build these diversifying ETFs up just to increase the diversification and the coverage that I have in my stock portfolio. The other stock that I recently bought in my account, and I may do a full video on this one, but it is S&P Global. So S&P Global is a company that owns the S&P. They own an index business. They have a market intelligence business. They do a bunch of different things, and they have a great moat on the business. Really hard to compete with them, other than some already defined companies like Moody's and some other companies on ETFs and stuff like that. But you can see over the last 5 years, they've really been able to leverage this moat on their credit business specifically, as they kind of grade corporate debt and other types of companies, up 90% in the last 5 years. So pretty strong performance there. I did buy 4 shares, so $1,500, pretty decent position to just jump in with here. About flat. The company pays about a 1% dividend yield. They've increased it for, I think, a couple decades in a row now, so that will continue to grow over time. But I'm really in this one for the growth, and then with that, the dividend growth should come nicely. They're trading at about a 28 times forward multiple. Not sure where this 53 comes in, maybe some accounting basis on the trailing side. Looking at this company a bit more, just going through some of their businesses here. So their biggest business is their ratings business. They operate in 27 countries, and they provide credit ratings to companies. So lots of people who issue bonds, like like I keep calling them industrial, but just investment firms that are buying and selling bonds usually require credit ratings from S&P or Moody's in order to fairly value those bonds, what coupon yield they should be getting on them. And S&P and Moody's just have the brands and the history that everyone, in terms of clients and investors, trust their ratings, and they need that kind of stamp on approval before investing large sums of money in those kinds of securities. So they bring in over $4 billion a year, really nice operating profits there, which speak to like the moat and the pricing power they have. Next is their market intelligence business. They do a couple $2 billion there, lower operating margins on this one. And then their global Platts business, they do about $1 billion. Lastly, their indices business. So think of this as just their indexes. Whenever anyone buys a S&P 500 ETF, they need to pay them a couple basis points. And same with Dow Jones, I believe. Whenever anyone buys a Dow Jones ETF, they have to pay them. It's a couple other things they're doing in this space, I'm sure. And this brings in about $1 billion. But look at the margin, 70%. So tons of cash flow in this company. They don't have very high capex, so they return a lot of money to shareholders after they invest in their growth opportunities. I just think this is a really unique company, really different than anything I currently own. As I look through my portfolio, it's completely software, not physical, really easy to scale, expand into new countries. They have a great brand. They have great, reliable businesses like that ETF business, like that credit rating business. Whenever anyone issues debt, they pretty much have to go to one of two players in order to get it to be investment grade for the most part. So I think they're in a really good position. I think they have a great moat, and I love investing in businesses like that, albeit a bit of an expensive valuation. But I think a couple years looking back, it won't be too expensive after they grow into it and their multiple holds, which I think it will, because their moat's not going anywhere. So that's a bit of background on the stocks that I've been buying this month, what's been going on in my portfolio. For the most part, a bit of a weak month for the overall portfolio, but really happy with the direction that the portfolio is going in terms of the new stocks that I've added to, and the opportunity to average down on some positions like my bank stocks at lower valuations with the dip that we've been seeing. So excited to talk about some of the stocks that I will be buying in September of 2023 in an upcoming video. But until then, thank you guys so much for joining this one. Let me know what you think of the changes, the new buys I've made in my portfolio over the last month. Would love to hear from you in the comments, and I will see you guys in the next one. Thanks.